what if the basket you're choosing is like the golden basket?
Made out of titanium. It's almost like people assume, oh, you can't build wealth if you want to be safe.
There are trade-offs in investing. Is there a way to not have to be so overly diversified and still be able to build wealth with a lot of confidence? A good question to ask ourselves is, can I explain why I own each investment I have in my portfolio?
It's like that drives us to just like make a decision, whereas we're not really led with confidence.
Okay, so we talk to so many people in our appointments, and I think we concurred that out of all the questions we do get, that there's always some main ones that we tend to hear more often than others. And one is, am I diversified enough in my portfolio?
Yeah.
This diversification question comes up either from that perspective, or sometimes they'll ask after, when we build a plan with our clients and we're putting it together, they might say, is this diversified enough? That this diversification word tends to be thrown around quite a bit.
Yep.
And is a very common theme that you hear in conversation around planning.
Yeah,
And
it
so-
almost seems like the end all be all, like it's the ultimate investment strategy is diversification.
Right. And so I guess the main idea here is, the concern people bring up, I think the cliche is, I don't want to put all my eggs in one basket, right? And so I think we want to kind of talk about today several aspects around diversification, but is that true that if you do put all your eggs in one basket, that's a bad thing?
Right.
Is it always bad?
Mm-hmm.
I mean, if you have a basket with a lot of holes in it, maybe it would be. But what if the basket you're choosing is like the golden basket, right?
Mm-hmm.
Versus all the other ones that have holes in it.
Made out of titanium.
Right, titanium, the
Yeah.
titanium basket.
The titanium basket.
Yes.
Indestructible.
Yep.
Never be touched.
Right. So the traditional wisdom is if you spread your assets among, multiple different classes of investments, this should help protect me for when the markets do have a downturn.
Right. The general consensus I find is that diversification, people feel it just reduces their risk, right? And like ensures that they're going to succeed.
Right. And so is that true? And so we looked at a couple reports. We're like,
Yep.
okay, let's get into this.
Mm-hmm.
Is diversification really as necessary as people make it to be? Or is there too much diversification? Is there not enough? Is there a happy medium?
Right.
How does this all work?
Mm-hmm.
And so we looked at, I know like Morningstar, and you can go to all these different third-party, research groups that research these things. And I think it was just the most recent one I think I found was from 2023. The Morningstar report said that, people who have what they call over-diversified portfolios, which they equated to, say, having, you can find this on your financial statement, but 20 or more asset classes. So that means
okay.
and I've seen this on some statements, you pull them up, and like on page 2 and 3, it lists out you're invested in this and this and this. And the list is just, it's like 2 or 3 pages long.
Yeah.
And so, 20 plus. So if portfolios are invested that way, they found that, get this here, that this compared to like just a well-researched portfolio that was maybe smaller, maybe 20 or less in assets, that being over-diversified underperformed on an annual basis by 1.5% to 2.5%.
Yeah.
Now, that doesn't sound like a lot
Right.
until you say that's annually.
Right.
So if it's 2% annually over 20 years, how much does that reflect?
Exactly.
Right?
So why is that?
That is because they found that because you're weighted over so many things, if you look at the S&P 500, for example,
Sure.
and you look at especially recently, the overall performance of the S&P has been heavily weighted toward only about 5 to 10 positions in the whole S&P.
Right.
The rest of them haven't been any drivers to that overall growth, really.
Mm-hmm.
So if I have in my over-diversified portfolio some of these good positions, you probably hold some of the good positions there, but if I hold a lot of the other ones,
Doesn't do much.
It's going to dilute.
Yeah.
Even if the top performing ones, double in size, but you're over diversified, it doesn't really move the needle that much
Right.
in terms of overall growth.
Yeah, because it's diluted in like asset allocation, but it's also diluted in like how much of your assets is in
It's
each
in
one.
that each one. Exactly right.
Yeah.
Yep, that's
Okay.
exactly right.
That makes sense.
Mm-hmm.
So
Yep, go ahead.
so why I guess like as far as like the general consensus, like the common belief saying like, hey, diversifications to keep you safe and everything like that.
Mm-hmm.
Do you feel like it's pushed when people say like they want a safer profile or portfolio because, like the thought is, oh, if they diversify more, they're going to be safer, whereas they're not keeping like building wealth in mind. They're just kind of being like, okay, let's just keep them safe and keep it out of the, like.
Yeah, I think there's both of those elements going on. I think you're right. And there's a lot of this can be fear driven. I think that's what you're getting at, is that they're afraid of losing a lot. Because, I mean, let's face it, there's been plenty in just the past. You can look at, if you want to look back at the dot-com bubble of 2000 and go forward 25 years, 2000, 2001, 2002, 2008, 2018, COVID, 2022. Like, there's plenty of experience for people to see their portfolios do a magic trick where it feels like it's here today and it's gone tomorrow.
Right, yeah.
The sleight of hand, right?
Yeah.
And so I think there's a lot of fear, and so they're driven to feel like they want to be more conservatively invested. And at the same time, there was another part to your question.
Yeah, it's like they don't have like it's almost like people assume, oh, you can't build wealth if you want to be safe.
Oh, right. But I think they also want the best of both worlds. They want to be safe, but they do want to grow wealth too, because
Exactly.
you have to. But there are trade-offs in investing.
Mm-hmm.
And is there a way to not have to be so overly diversified and still be able to build wealth with a lot of confidence,
Right.
and not feel that fear? And so, I like what Warren Buffett said. He said, you got to think of your investments like a buffet. If you go and grab everything, if you grab sushi, ribs, shrimp, the best bread over here, dessert, if you grab it all, you're going to end up with just a stomach ache and ruin a really good meal, right? And so too much on your plate waters down the overall results, like we're saying. And so what I think is what a good thing that people can do is, when they look at their portfolios, you say, am I over diversified? Am I weighing too much on this fear? Can you explain? A good question to ask ourselves is, can I explain why I own each investment I have in my portfolio?
Right.
Can I point to the top 10 or 15 best performing stocks or positions that I have in my portfolio?
Yeah.
These are things I think are important questions to ask.
Yeah. It's almost like making a decision out of fear, like the fear of putting your money in the wrong investment, or fear of like, my money's not growing right now, it's just in my savings, I need to figure out what I'm going to do with it, or like I just don't want to mess it up because I have a family to take care of, and I want to leave something for my children, like whatever it is that you're afraid of, that point inside of you you're afraid of. It's like that drives us to just like make a decision, whereas we're not really led with confidence by due diligence and education and research.
Right.
Whereas like you're saying, it's so important to actually understand what you're investing in. That doesn't mean that like if you're somebody who is like, I really want to be hands off, I don't want to think about this all the time. That doesn't mean that it can't be like that. But you should at least do the like the self-education, or get the education ahead of time, so that you understand what you're investing in, and then you can better make a decision on where you want to move your assets. And more often than that, it's probably not going to be in 20 different things.
Right, exactly. And to your point there, where there's a lot of people who would rather be more passive and hands off.
Right.
Totally understand. Everyone has kind of a different disposition when it comes to their portfolio. However, when you're over diversified, You might be passive, and then one day you open your statement and go, oh my gosh, what's happening in my portfolio?
Right.
Guess what? You are going to find yourself in a position you wanted to be passive, but now you're going to have to dive in and find out what's going on and take a very proactive approach
Right.
and to trying to rein in and right. And when you're in retirement, most retirees we talk to, they want to know what's going on. And I want them to know why and be educated, but they also want to be traveling and being with their families
Right.
and trust that everything is going to be moving along.
Right. So it's almost counterintuitive to be
Too
over
passive
diversified, and
and passive.
it's like a pendulum. Like you got to be like somewhere in the middle, because like you can be too passive,
Yes.
but then it's also like if you want to be passive but you're over diversifying,
Mhm.
it's like it's counterintuitive. You can't do that, because
Right.
then you're gonna find out where all these things are going wrong a year down the road, 2 years down the road, and you're like, oh, now I got to look into this again. You
Yep.
know?
You got to be back on it. And so with the multi faces of fear too, you're talking about the fear driven. The other side of that fear too is for some people, they hear, oh, such and such XYZ company. Have you heard? They're doing da da da. So the
Yeah.
fear of missing out on these opportunities, they're like, well, I got to have some of my investment in this.
Yep.
So there's the fear of missing out, the fear of losses. You can see there's a lot of emotion in fear-based thinking that drives a lot of the decisions that people make
Yeah.
in their investing,
Mm-hmm.
where education and having good, if you're going to work with an advisor, having people around you that can build the plan with you and help you understand why you're buying what you are. I think that gives the investor armed with more information, gives them the confidence to know that where things are going to go
Yeah.
when they can understand the mechanics, at least to some degree,
Right.
of
Yeah.
what's happening in their portfolio.
Yeah. That's huge. I think
Yeah,
just making a decision in confidence is so important.
it is. And the other thing too with the over diversification, you can think of it this way: I've seen some portfolios that have 200 or more stock positions.
That's insane.
It is.
Yeah.
Because doing it that way, I heard someone tell me once, they're like, that's like having 200 children and expecting them all to be on the honor roll.
Right.
Right. Good
'Cause
luck with that.
Stocks
right?
are emotional, just like children too, and they're needy.
That's right.
Yeah.
I think, you and I were having a discussion before, but you look at like one of my favorite restaurants, Chipotle Mexican Grill.
Yep. I eat there all the time.
Yes, Chipotle.
Chipotle sponsor us.
Yep. So here's the thing. Like, it was just a few years ago, they had an E. coli breakout.
Yeah.
And so, of course, it's all over the news. E. coli breakout at such and such locations with Chipotle. What did some investors do? You saw the stock price begin to drop. Okay. Now, what does that tell you? Now, to just the surface observer, people might start to panic and think, oh, there's something wrong with Chipotle.
Yep. Chipotle's going out of business.
Right. So they began to sell off.
Yeah.
But to the educated investor, this is what they knew. They're like, you would understand that for Chipotle Mexican Grill, for example, what's their value proposition? Their proposition is basically, and I know I'm going to miss some details here, they want to have a healthier option in the type of food that they're making for people. So when they build a Chipotle Mexican Grill, they have to know that there's local, organic farming food sources within the distance of each location, because they want to locally source their food on a daily basis. They pride themselves on nothing's frozen here. It's all fresh daily, right? So then people go in, they feel like they know they're buying a healthier option of food, okay? So then when this E. coli breakout happens, the educated investor on Chipotle Mexican Grill would say, is this event terminal to Chipotle? Is this driving them out of business? Probably not.
Right.
We see the leadership getting on this. They're going to correct the problem. And sure enough, they recovered from it. But what did the wise investor do when everyone else was panicking?
He bought shares.
They bought shares because they went on sale
Mm-hmm.
in their mind. They bought a good, and then the stock price returned and they made money on it.
Yep.
Because they are educated on the company, they knew what they were buying. And I think that's just a microcosm there, but just a quick example of how fear versus education can really be helpful with an investment when
Right.
you're making a certain decision. And just a little disclaimer here, this is not to advocate that we are saying you must go out and buy Chipotle Mexican Grill
Nope.
today.
Nope.
This
Yeah.
is not to be meant as advice or anything, but just an example to show how fear works sometimes in the investing space.
Well, then would you also say that like the whole like idea of how like complexity sells, like that whole thing kind of plays into the fear as well. Like people feel like, oh, this is too complex for me. But it must work really great because it's super complex, like I don't know. It doesn't necessarily have to be complex to be successful, but like I feel like the common thing is just like have a complex portfolio, be diversified, get complex products, like all these different things.
Mm-hmm.
And it might not necessarily be the truth, but people are just like scared they're making the wrong decisions. They're like, well, that sounds complex and smart, so I'm going to put my money there.
Right. I mean, if you have an industry that markets in such a way that makes it feel complex and confusing, which is not in every case, but a lot of marketing messages are around that. Even headlines in news sources will, the S&P 500 drops 900 points. Everyone, right? You feel that you want to, your nerves
Right.
begin to signal to you, oh my gosh, maybe there's something wrong. So the messaging makes people feel many times, this is too complex for me.
Yeah.
So I need these portfolios and these people to advise me on this. But sometimes this advice, because the industry's putting people in these over-diversified portfolios.
Yeah.
Right?
Mm-hmm.
And so if you feel like it's complex and that's the message playing in the subconscious, you're going to react and act accordingly. And so that's why I think your point and your question is really well placed, because there are simple things people can do and learn. It's not as complex as you're made to feel. There is simple information and good education out there to help you feel empowered in the plan you're doing, where you can feel confident in what you're doing and to know why you're doing it. I think that's really important.
Yeah.
And if that's not what the advice you're getting, find where you can get that advice.
Right.
Because that's absolutely true.
Yeah.
There's simple things you can do today to make it to optimize, rebalance your portfolio and make it do exactly what you needed to do to achieve your goals.
So in another way, then, with diversification, then, people think that like if you're in all these different asset classes or whatever, then they will like counteract each other. When one goes up, one goes up, one goes down, kind of thing,
Yes.
Where is that necessarily always true?
Yeah, that is great. Yeah, 2008, I think, drove that point home really well. They call that low correlation. Like, I'm in real estate investment trusts, I'm in mutual funds, I'm in stocks, and I have bonds, let's just say, okay? And so these are all different types of investments or asset classes that aren't related necessarily, right? So if real estate's having a bad time, the thought process goes, that doesn't necessarily mean that my stocks and maybe mutual funds are doing bad. And so one's going down, the other should be able to maintain or go up. But when you went through 2008, that was not the case. People learned the hard way that low correlation does not mean that you have less volatility in your asset classes. People saw losses across the board in all asset classes during that one experience. And that's not the only experience. I'm just using that as one example. It's happened multiple times. And during 2008, I think it was 30% losses, around all asset classes. During COVID, we saw it.
Yep.
And so low correlation does not mean more safety and preservation of assets. That's definitely been proven time and time again. Great. Yeah. That's a great point.
Yeah. I wanted to talk about that because I think, like you said, it's not necessarily as true as you think. And some people are like, oh, well, like those are like one-off things, that happens every so many years, but it's not like a common thing. Sure, but I mean, a 30% loss is huge.
Right, and especially if you're 63,
right,
and you are ready to retire in 2 years, and the low correlation fails you,
right?
What then? Well, we've talked to people where this has happened. They're like, well, I'm going to have to work longer now.
Right.
I'm not going to be able to retire. I'm not going to be able to do what we were planning.
Right.
Because that strategy failed them. And so, if you're really young and you went through that, you have time to change, you have time to recover and recoup because time is the key element there.
Right.
Yeah. And just to correct one thing, the 30% quote was during the COVID-19 was when the 30%
Oh, okay.
stat came out of Morningstar there. But in 2008, the same thing did happen. I just don't have a report on that year, but I know the lower correlation failed during that crisis as well when the housing market collapsed.
Yeah.
So, the last thing there too is, the other diversification issue that can arise is what we call the overlap. You're in, 20 plus asset classes many times, and you can go to Seeking Alpha, Yahoo Finance, Morningstar. There's these different places you can go, and you can put in your different ticker symbols for the positions you hold and find out how many of your existing positions you hold have the same investments in them.
Yeah.
Right? Where, these 5 positions are in this fund, this fund, this fund, this fund, this fund. And it's like, why are you holding the same investments? You think you're diversified, but you're really owning a lot of the same stuff.
I'm in multiple mutual funds,
owning the same things, but you're paying for each of those funds.
Right.
So you're probably paying more in expense to hold the same positions you could hold in one.
Right.
So that is definitely something you want to look at as well. Am I diversified? Am I overlapping investments across my different positions that I'm holding?
Redundant exposure.
Redundant exposure. That's exactly right.
Yeah. Okay.
That's a great word for it. Yep.
Yeah.
So, I hope it's helpful for people, just to food for thought. Is some diversification okay? Absolutely.
Right.
A little salt on the meal makes it taste good. Too much salt can ruin the meal.
Right.
Right.
But what we want to point out is there's like this fallacy that like diversification is
the end all be all.
End all be all, and you need to diversify.
Or else,
right?
Mm-hmm. And that is just proven not to be true. And so, suggestions, go through, like we said, number 1, can you tell yourself why you hold the positions you do hold? Aside from not just saying because this is what my guy or gal put me in.
Right.
But do you know why they put you in there? If you can't answer that, get answers. Ask, why am I in these positions? Do I understand what I'm invested in? Because I also think there is an element for some people that they want to own things they believe in. And I don't necessarily mean that there has to be a moral connotation to it. There can be.
Yeah.
But the meaning behind the investment can be that I understand the investment.
Yeah.
I understand what it does, how it works, the mechanics of it, or why I'm owning these companies, these stocks, right? So why, and do you understand them? I think those are 2 really important elements. And if you can get to the bottom of those, you're going to feel a lot different about your investments than maybe you do now. And it might help eliminate or reduce a lot of that fear that's driving a lot of the decisions that are happening now. And that's what I hope most our hearts are for our clients. They can feel confident, assured, and feel peaceful about the direction they're taking.
100%. Yeah. Because this is their life, you know?
Exactly. This is their life, their future, their legacy to their children. And so, I think this was a good discussion.
Sweet.
Yeah. If you have any questions, you can get a hold of us. We're going to have links in a lot of our episodes for our articles that we release on Substack. We'll have some notes in this here, places you can go to read some of these stats on diversification. And until next time.